fallout now from that announcement that President Trump and First Lady Melania have tested positive for the coronavirus. As they head into a 14-day quarantine, let's get some business news. Catherine Bennett is here with us in the studio. And Catherine, it would appear that investors did not like that news very much at all.
They did not. In the US, stock futures plunged in early morning deals, with the Dow futures plummeting 500 points. Now, that's since pared back a little. The S&P 500 and Nasdaq futures dropped into negative territory as well on the news. Turning a little closer to home, indices in Europe have also been faltering as a result of that. The FTSE has shed over 0.75%. France's CAC 40 is down 0.8%, and the DAX also dropped 1%. Now, for analysis on this, we can talk to Craig Erlam, a senior analyst at Oanda. Craig, thank you for being with us this afternoon. Now, can you tell us, what is the market reaction around the world, and what do you make of those figures?
Well, I think it's important to note that one thing that this does create is uncertainty, and the old cliche, the old adage in the markets is that it hates uncertainty, and I think this is probably driving much of the reaction that we have seen today, rather than it being an assessment of what it ultimately means maybe for the US economy or for even Trump in general. We know he's tested positive, but we don't know if he's having any major symptoms. We don't really know. For all we know, he could really be asymptomatic at this point, and it may have little impact in terms of his position, his campaign, or anything else for that matter. So it's very hard to say, but the markets do hate the uncertainty which has now come with this announcement. And I think the other thing we have to take into consideration is this comes against the backdrop of Congress failing to pass a fiscal stimulus package, and it seems that that's taken another step back again this week. And we've also got a crucial jobs report in about an hour's time. So I think the market was probably already a little bit cautious, and I think this announcement may have just tipped it over the edge.
OK, and what sort of effect could this have on investor sentiment in the long term? Could this have an impact on the financial recovery in the US, for instance?
So the impact will depend on the severity of the president's condition. If it does become more severe, if it's something, for example, like what we had here in the UK with Boris Johnson, then that could have serious implications as far as the election is concerned. We're kind of in unprecedented times, and we seem to use that word a lot now, but we really are, and this is just another situation like that. It's still not clear what impact this will have on his ability to campaign or on the election itself. I think that's something that will become much more clear in the coming days. So I think that's probably the most significant impact it could have. In terms of the future of the economy, I don't think it makes too huge a difference. The fact remains that Joe Biden has a significant lead in many of these polls, so it's unlikely that this will actually affect the outcome of the election itself. So I don't think the longer-term economic or financial market implications are going to be too severe.
OK, thank you. So we'll be seeing uncertainty in the markets in the days to come. Thank you very much for speaking to us on that, Craig Erlam. Now, almost 20,000 Amazon employees in the US have had confirmed or presumed cases of COVID-19. The e-commerce giant finally released figures on Thursday on the number of cases in its US workforce. It had refused to do so for a long time, saying that the data would be misleading and lack context. Between the period of March the 1st and September the 19th, Amazon said that there were 19,816 presumed or confirmed COVID-19 cases across roughly 1.37 million frontline employees. That's less than 1.5% of the total. The company received a lot of criticism during the first few months of the pandemic for failing to do enough to protect its workers. The EU has taken the first step in forcing big tech companies to share customer data with smaller rivals. EU leaders in Brussels on Thursday agreed on a draft of the Digital Services Act, a huge proposal that will completely overhaul how internet platforms are regulated. Camille Nedlek has the story.
Big tech in Europe is squarely in the firing line as the European Commission writes up a law that would subject the likes of Google, Amazon and Facebook to new rules. The Digital Services Act would update legislation dating back to 2004, when those household names were much smaller.
The current framework of rules therefore needs to catch up. It needs to catch up with new realities that we are facing. And it needs to ensure that public interests, fundamental rights, and the users' and consumers' rights are protected in the new digital realities.
Tech giants could be forced to share data with businesses using their platforms in order to avoid an unfair advantage, a solution to a problem current laws have had little impact on. Amazon, Apple, Microsoft and Google have wrapped up over a dozen antitrust court cases between them, with several still ongoing. Google alone has been fined billions of euros. The EU would also be able to stop big tech from monopolising new markets. But Google argued that the restrictions shouldn't be too broad.
A blanket approach to ex-ante competition regulation could have unintended consequences on user experience, as well as multiplying costs for European businesses. That's why we recommend first, fully and on the facts, assessing the effectiveness of regulation that is already in place to ensure that markets are working properly.
The legislation will be debated by the European Parliament and must be approved by all 27 member states. And many amendments could be made before it finally passes into law.
Soon anyone will be able to buy a share of the iconic brand Playboy. Playboy Enterprises is becoming a public company again 9 years after going private. The lifestyle magazine, famous for its iconic bunny symbol and its pictures of naked women, is going to merge with the firm Mounting Crest as a shortcut to Wall Street. The company stopped printing its magazine earlier this year and has now pivoted to consumer products, including clothing and gaming. The merger should be finalised early next year, after which it will list on the Nasdaq. And that wraps up the business from me.